Hey, this is John. Today I just want to talk about the predictability of financial crises. I don't actually think that the flopping the microphone is working very well, but I do have to have the fan on today because we're still in part of that heat wave, and this is going to be a much longer video than last time. Um, yeah, and so today I'm just going to go through this article from the Harvard Business School. I'm not going to go through the whole thing, just the introduction, and kind of give a brief kind of overview of what they're actually showing here, and talk about some of the different. Because again, I'm just using this as a scaffold, basically, for our financial crisis predictable. Yeah. Okay. So there's that. Then the book this week that I'm reading, because I'm still doing the thing to combat the literacy crisis that fortunately is having a huge effect on people's ability to read. The book that I'm reading this week is the Tractus Logico-Philosophicus from Wittgenstein. So I'm reading that in the original German, but it is kind of interesting, actually, in that respect, because the way the German's written is a little bit different from the English translation. And if you're familiar with translations at all, that'll kind of make sense. The main premise of the book, by the way, although it was later sort of redacted by Wittgenstein himself, and so I'd recommend, if you are going to look at Wittgenstein's work, you actually move over to the philosophical investigations instead. But the main point that he was trying to make here was basically that there is a logic to language, and the idea that language maps onto objects makes many philosophical problems difficult or impossible to discuss, and that's where a lot of the problems of philosophy arise, right? Now, some of this is sort of debunked by him, some of this is debunked by linguists, but it's still an interesting logical read nonetheless. And for example, because there's some discussions about, how influential is Wittgenstein really. This isn't a video about Wittgenstein, but just to give you one example of something that he did do is he did invent the logic tables. So anyways, blah, blah, blah. But let's get into the video. So predictable financial crises, what is this all about? Well, basically this research is looking at post-war financial crises, and they're showing that credit booms and asset price increases are correlated with, in the following 3 years, the likelihood of a crisis, right? Now, they show that there's about a 40% chance of a financial crisis, based on that, which I think, I will say that the substantially predictable comment is probably a little bit overblown based on this. I do think that it's more accurate to say that they have factors here that, in fairness, already made sense theoretically. Now, this article is from 2021. That already made sense theoretically, but showing through the math approximately what percent chance is associated with that. But yeah, basically, increased credit and increased asset prices will correlate with financial crises over a 3-year period. Okay. So there's a few things to point out here. So first is that this is interesting to contextualize in light of, say, David DeRosa's work, which was on bubbles, right? So I've talked a little bit about his book, Bursting the Bubble. But what David DeRosa focuses on isn't necessarily financial crises, but asset bubbles preceding, often anyways, financial crises, where there's basically a substantial overvaluation of assets, and then that overpricing of assets gets deflated very quickly, right? And that's kind of the idea of bursting a bubble. So you see, for example, a stock price crash, right? And so David DeRosa goes through a lot of statistical models, pretty much everyone on the market, and and it's more in depth, I would say, than this, but it's not necessarily related to crises, right? So this is not necessarily conflicting with that work, but David DeRosa does show that financial bubbles do not seem to be predictable with respect to traditional theory. Okay. Now, aside from that, the traditional theory suggests, as they, write, I'll change the color of this, as they write here, is not considered predictable. Some of the research that I've done on the matter does agree with that to an extent. Now, of the kinds of factors that we look at to say which ones are the most correlated with the potential for financial crisis, we generally look at the interest rates set by the central bank, and GDP and inflation. And part of looking at inflation is because of its relationship to the interest rates, right? The central bank is going to use inflation data in addition to some other factors, but namely inflation, to decide what its interest rates are going to be, right? So maybe that's part of the reason why inflation is so important, or maybe why interest rates are so important, right? But those are generally kind of the most the biggest ones in theory. Though some of the research that I've done has shown that the for example, with the S&P 500, and this isn't necessarily surprising, but the major correlate with S&P 500 movement is tech stock prices. And that should be unsurprising, but basically if you take a proxy for a tech industry, then you will find that there's something in the ballpark of like a 0.8 to 0.9 correlation in recent history, right? So whether you look at it over like the last 5 years, 3 years, 5 years, 10 years, 20 years, right? Because I split it up into different historical time periods, you'll find about this correlation, right? And that's unsurprising because the S&P 500 is very concentrated in tech stock. Very concentrated in tech stock right now. Hope that's still working. So yeah, obviously it's going to move quite a bit with that. And the S&P 500 itself is fairly important for financial crises, right? So I would suggest then that anyone who's looking at financial crises going forward, that they do look at the tech industry or pay particular attention to that. There are other factors that are sometimes found in research to be important or correlated with, for example, the S&P 500 or other indicators of financial crises. Sometimes, though, most of the time, the ones that we do find that are correlated are not necessarily useful because they're measures that only make sense mathematically, but you can't exactly think about it in a real-world context, right? So it's basically looking at, mathematical signals, for example, and which might be on, data that is potentially 5 or 6, etc., dimensional. So those aren't necessarily useful, and so it's hard to say that they're really, if a crisis relies on data that we can't understand, is that really predictable? Not really in a useful way, right? Okay, so there's that. And then this research is also interesting to look at in light of the recent if you would consider it is probably not exactly a financial crisis. We may or may not have a looming financial crisis at this point, though we did have a crash in 2025. It does look like there's probably another one brewing up, though the reason why this is interesting to look at is, one, because that was definitely substantially predictable, though not by statistical means. I just mean by, paying general attention to the political landscape. Yeah, and I think to make it kind of different from, say, saying something like, oh, well, 2008, if you just paid attention to the bond ratings that were being the ratings of the mortgage backed securities that were being granted by some of the large companies. If we just looked at that, then it would have been very predictable. Well, the difference between that and what just happened is that I actually did predict those things. So I'm not just saying that in hindsight, and then coming to hindsight bias. That's something that I would say was very predictable prior to it happening, and I was sort of surprised that it seemed like nobody was commenting on that. Well, people were commenting on that, but I mean, in particular the banks, right? And people in the investment sphere, and we know that the market did react to that, so they really did not see that coming. Somewhat funny. Okay. Anyways, so and I did kind of comment on that. Yes, crises are often preceded by economic fundamentals, but are often not, substantially predictable. One of the reasons for this is, and you'll see this a little bit in the article, is that economic fundamentals being weak often don't lead to crises, or maybe sometimes strong economic fundamentals, or countries with strong economic fundamentals, such as a strong currency, might still enter a crash, right? Because there's lots of things that can happen to cause a crisis, right? To give you one example, it could be an issue with another country that has a lot of money invested in your domestic currency, and then them just say pulling a bunch of the money out because of the problems that they're facing, right? That could cause a big issue for your economy. So just to give you one example of that. Okay, now what they show again is that credit booms, so people taking out a lot of debt, which will increase inflation, and the increase in asset prices are both correlated with financial crises. So why is that? Well, basically, as I said right here, from this, in a sort of like more general overview, and then I'll talk about a little bit from a more mechanistic standpoint. There's going to be increased inflation, so the taking out of credit and loans will increase the money supply and then dilute the value of money, which increases inflation, right? And that obviously decreases spending power. One of the problems is that if things get more expensive and people have, lower value of money, is that you see more defaults sometimes in these scenarios. You also see overvaluations sometimes, well, in the case of asset price booms at least, but credit booms also support that, because what's, typically, or what often happens is people take out credit and they'll use that to buy assets. That can push the asset prices up because, again, in case you do not know, the purchasing of assets pushes the price up, and the sale of assets pushes the price down, right? So if you take out credit and you buy assets, then that's going to push the asset price up, right? And sometimes, in particular in a credit boom, this can lead to an overvaluation because, people believe the money is very cheap at that time, right? So, for example, interest rates might be very low. And so then, credit's cheap, people buy a lot of assets, the assets can get overvalued, right? And in particular, this is a problem way after the fact, when the asset prices come back down to their fundamental value, and then you see a lot of defaults for people who need to sell those assets, and I'll explain that more in a bit, but the idea is that in particular companies often have to sell the assets to maintain their debts, but individuals can have that issue as well. Okay, So increased credit allows increased buying from the consumer and increased expansion on the side of businesses, right? And so in that respect, it is useful to the economy because both of these actions, consumers buying goods allows business to expand, and the reduced cost of credit allows business to expand, and that can create more jobs. And at least in the past, that had correlated with improved wages, right? Okay, and then obviously if businesses are expanding and they're making more money, then that increases the asset prices. And just, again, to give you one idea of how the mechanism works, sometimes this can get pushed up above the fundamental value. And then if the price drops, one of the things at larger companies is that they often have stop losses that get triggered, right? And so this could be something that happens as part of the institutional investment portfolio to maintain, for example, certain debt covenants, right? So they have, certain debts that they need to cover. Those could also happen for individuals, and this is why, sometimes I criticize the, commentary regarding, you should just hold on to your losses. A lot of people don't necessarily have the option of doing so, and maybe because, they need access to that money, especially in a time of a financial crisis where, they now have, very basically increased inflation may decrease the value of their savings, and they have less money to go towards their debt, right? Which, might be their mortgage or their, a car loan or something like that, right? Which means that to pay those things, they need to sell assets, and they sell those assets at a lower value, and so they've lost, more money that way, right? But also, too, the selling of assets, as I talked about earlier, pushes the price down. And so this is sometimes the basic mechanism for how a market crashes, right? And this is, well documented in a lot of economic textbooks. So, you can read about it more there. I think the term is inflationary spiral. I think that's the term. But, yeah, the idea is that, things just crash and they keep crashing because people have to continue to sell. And as the asset prices decrease, they have to sell more and more. Now, so that's how, an individual might have that problem, but, companies do also have debt covenants that they need to maintain. And so some companies have, contractual obligations to do so. Okay. And so that's basically how that works. Now, that was a lot on that topic. I think I rambled a little bit, so I'm sorry. But, so then, obviously, non-financial business and household credit forecasts both contribute. We do want to say, so again, just to, clarify, right, they say 1 standard deviation rise in real 1-year credit growth leads to a 2.8% increase in the probability of the crisis over the next 5 years, right? I think I comment on this later. Yeah, so first, could you increase the time horizon, so they say over the next 5 years? Could you increase the time horizon? Yeah, but, at a certain point, you're going to get away from the factors that you want to look at because all crises are sort of context dependent. All the factors that you look at are context dependent. And if I said, something is, the predictions of a shaman 20 years ago had a real effect on the financial crisis today, there's no way to prove that, because if you just extend your time horizon over as long as you want, eventually you will end up with a crisis, and you could say, okay, anything prior to that was, could factor in some way. So you want it to be relatively tight. So can we increase the forecast length? Maybe, but it wouldn't really be useful, probably. And then just to clarify, too, the standard deviation increase. So, 1 standard deviation is approximately going to be, so again, it's a standardized measure, right? So it measures, from the, I don't know if the people know, watching this know what standard deviation is. I apologize if you already know. But you start from the mean, right, of your data, and then you're looking at about I think 16% above that, right? Sorry, about like 32-ish%. And so you're looking at about like the top 16% or whatever from a one standard deviation, right? Yeah. So in other words, an 8-year high, give or take, about an 8-year high of the credit growth leads to about 2.8% increase in the chance of a crisis over the next 5 years. So again, just to kind of cast a little bit of doubt, I guess, on the language of are these substantially predictable? Not really. Are these useful predictors though? Yeah, for sure. Additionally, we'll kind of scroll down and we'll see that there is an interaction effect, and the interaction effect is more important than either the two individually. And again, it's because of the theoretical mechanism that I explained, at least most likely due to the theoretical explanation that I gave earlier, right, on the what happens when you combine credit booms with asset price increases, and what the consequences of that can look like. Okay. Let's just quickly explain what an indicator variable is, because basically what they do is they create a red zone, or this measure to showcase, okay, are we in a problematic, do we have problematic credit and asset price growth, right? So an indicator variable is basically just binary categorical variables to say, so here I write 0 or 1. It's basically, are we or are we not in that zone? Is this thing true or false? So when I say, binary, I just mean it's a yes or a no. So I guess another example of this would be if you are running some kind of correlation and you want to use a variable like above a certain threshold, like I don't know what you might be looking at. Like let's say you're looking at like let's pick something else. The number of like books that people read in a year, right? And you want to know, okay, how can we classify people in group above, say, reading 50 books a year or not, right? That's one example, maybe the indicator or dummy variable. Okay. You probably wouldn't choose that, but yeah, anyways. So here they choose a red zone, right? So again, just say in it or not. Okay. Quintiles are fifths, terciles are thirds. So again, just to give you some context there. But they set up, red zones, blah, blah, blah. And then basically the probability of a crisis at a 1-year horizon is 13% if they're in the business red zone. And again, that's 1 year. And then within the next 3 years is 45% in the business zone, red zone, and 37% in the householder zone, right? Okay. And then where do they do the just trying to find where they have the interaction effect. Okay, I don't know where they have the interaction effect, but anyways, but you can see here a commentary on, basically the degree of predictability increases substantially if you have both of them together, and so that's what I mean by the interaction effect. I don't know where the data actually is, though, but I know that at the top in the abstract, they listed about 40%, so it should be around there. Okay, then similar across historical chronologies. Which is important because if you want to say, basically different crises are established by different issues. So if you wanted to make a factor that's robust, it doesn't necessarily have to be across every historical period, but you do want to understand the factors contributing to the context in which they occur. That makes sense. So, for example, maybe it's the case that that credit booms only contribute to market overvaluation when there's also, say, an increase substantially in advertisements from companies, right? That could be one factor that you might have to consider, right? So just to give you an idea of context changes. It could also be maybe the looming threat of a war, etc., right? Okay. Cool. These are separate phenomena. There it is. 64% of the crises in our sample were preceded either by a household or business R-zone event within the prior 3 years. Okay, so 64% of the crises. Now, one of the important things to understand about this, and why this isn't necessarily, going to say, okay, is this, substantially predictive of a crisis, is that, yes, while it's true that most crises seem to be preceded by these events, and again, I think that makes, theoretical sense, as I explained, it does also take for granted that those crises had occurred. Whereas when you are using those predictors to say, okay, will a crisis occur? It's not necessarily given that a crisis will occur, right? You're predicting ahead of time, and that's where these things are useful. Yeah. So I guess, like, for example, let me not give an example. Don't give any examples. Okay, but anyway, somewhere down here they also do comment on, I think, about a third of crises actually. Where is this? Anyways, something like substantially fewer of the crises. Of the time that those indicators do occur, crises do result. So yeah, just keep that in mind. Yeah. Okay, and then one other important thing to mention as well, and I mentioned this kind of earlier with the commentary on things like currencies and investments from other countries. It's not surprising that countries that are sometimes not in the R zone, alone, can also be affected by other countries that are in the R zone, right? So they establish here, for example, that while Germany was nowhere near the R zone in 2007, 33% of the sample companies were in the business R zone and 36% in the household R zone at the time. And then Germany experienced a crisis in 2008, right? Okay. So, and again, that's due to a number of factors. Countries are not islands. They are implicated, heavily in a network of trade and investment that gets, flows across the borders, right? And so they're all, interdependent in that respect. Okay, and then this here is just a sort of basic discussion of, like traditional statistics relating to false positives and alpha and beta considerations, if you know what those are. But should we, are we ever overreacting, say, or is there a big cost to a false positive? So in other words, if we use these predictors to say, okay, maybe we should act in advance of a financial crisis, is there going to be a big cost if a financial crisis doesn't actually occur? And basically what these researchers say is, okay, well, probably not, so, we should try to act prior, right? Okay. So, anyways, it doesn't matter what that says, but, so the main point that I'm trying to say is that, yeah, there's, some theory going into the prediction of financial crises. Most of the time when you try to do it, it's going to be a waste of time. I think most people understand that though I have apparently found some success in deviating away from the statistical considerations. There are also problems with that, method though. One is consistency and the other scale, right? If you rely too much on a single person's interpretations of events and expertise and, also heuristics, right? While that can be more accurate than, relying on a standardized model, can you really pass it on to somebody else? Will you be right every time? Is it easy to give that a number as well? And the answer to all those questions is pretty much no. So, how useful is that really? Kind of not. So some of the stuff that I've used to kind of make some of those predictions in the past, for example, right? And again, the most obvious one was the thing with Donald Trump, but that was so I just felt I didn't even feel smart about it. I felt like the market was just stupid. Because you got to think, okay, if a guy is saying that he's going to do something for a very long time, like say a period of several months, then if he gets elected, that the chances that he's going to do that are probably higher than 25%, right? And so the main criticism that I had with the market at the time, and it seemed to be true in hindsight because the market did crash, was that it was granting a 25% chance to do things that he was saying that he would do for months. And that didn't really make sense. So was there an opportunity in, to go long volatility? Yeah, and if you went long volatility during that time, you would have, made probably quite a bit of money. Yeah, so easy stuff. Now, one thing that you could do to sort of operationalize those kinds of things, though, right, to, try to leave with, I guess, a little bit more in case any of you are interested in modeling. I guess I should stop making fun of people that make fun of me. But, although I obviously have no idea what I'm talking about, I guess one of the things that you could do is you could take those, just come up with a measure for political bias in the market. Yeah, and then use that, give it a score and use that to try to figure out maybe the relationship between that and volatility in the market. That's one way that you could do that. And how might you come up with that score? Well, there's a lot of ways that you could do that. You should do all the thinking yourself, to be honest. But, one thing you could look at is sentiment in, say, reports compared to sentiment in, say, political news, and then look at a measure of the difference. And you could say, okay, well, maybe that will give me an indication of bias. You do some testing, et cetera, right? I guess I'm going to stop sharing the screen, by the way. But, yeah. So, other than that, again, financial crises are probably not super predictable. But those are some of the things going into it. I guess, again, how does it relate to today? Well, this video is getting long. You will revisit the topic. For now, you can think about that at home. And so I hope that was informative, and the audio is not too bad. We'll try to also improve the upload schedule a little bit. It's been a little bit hectic more recently, but yeah. Anyways, take care. Bye.